Good morning, good afternoon, good evening, so whenever you're watching. Okay, in this video we are going to discuss about the some problems about the swap ratio. So first start with the meaning of the swap ratio. Okay, swap ratio is nothing but swap ratio or exchange ratio or share exchange ratio, these three terms are same only. Okay, it refers to the number of shares that the acquiring company offers to the shareholders of the target company in exchange for their existing shares. Okay, is nothing but how much of shares actually offered by the acquiring company to an acquired company. Okay, just imagine. So okay, there will be two companies. One is a XYZ company, another one is a ABC company. So XYZ company is going to acquiring the ABC company. So in this time, so they have the 80,000 shares of, so one shares is valued of 10 rupees, and in other side XYZ company have 1 lakh shares, and then each shares cost of around 20 rupees. Now XYZ company is going to acquiring this entire company. So while acquiring this entire company, how much of shares XYZ offering to the ABC company's shareholders? So that's calculation is called as swap ratio. Swap ratio is nothing but how much of shares offered by the acquiring company to the acquired company. So how much of shares they are providing or offering to the acquired company. So here that acquiring company, so number of shares that the acquiring company, so this is the XYZ acquiring company offers to the shareholders of the target company. Target is ABC company. It's clear. So how much of shares they are actually offered by acquiring company to an acquired company. So that calculation is called as an swap ratio. So under that swap ratio, so in order to evaluate the business valuation, so we got then three approaches basically. So that is an net asset method, and then earning per share method. So okay, here earning per share method, here I'm considering both are same, income based method and earning per share method, because earnings here that we are calculating the shares. So we are going to calculate the share exchange ratio from the perspective of the shareholders. But income based approach will tell us, so we are doing the valuation according to the how much of earned by the business. But in this context, we are giving a preference for the share exchange ratio. That's why I am considering earning per share and income based method. So both are same. And the last one is market value method. So market value method and then market price method. So these terms are same only. So keywords first try to understand basically what it is. Okay, net asset method. So okay, net asset method, here we calculate how much of book value company have acquiring company by the acquired company. So through ideas or through these two items, we are going to ascertain the swap ratio. So first of all, what is the meaning of the book value? Okay, book value is nothing but basically how much of they have assets minus liabilities. When they are deduct all the liabilities to and their assets, so what is the rest of amount? That amount is called as an book value. Okay, just imagine one company is there. Okay, imagine there is a company Infosys. Okay, in Infosys company, so currently their liability is 100 rupees, and they own the assets they have around 200 rupees. So their liability is 100 rupees, their assets is 200 rupees, the rest of the amount is 100 rupees. So that amount is called as an book value. So basically what's the formula for the balance sheet? So that balance sheet is asset is equal to liability plus capital or equity. So liability plus capital is equal to assets. In case that liability is 100 rupees plus capital is 100 rupees, and then assets become 200 rupees. So that these assets minus liabilities, the rest amount, the difference amount is called as an book value. So with the help of this book value, we are going to ascertain the swap ratio or share exchange ratio. So that called as a net asset method or assets approach. And the second one is earning per share. The word itself is telling. Earning per share means how much of money earned by one individual share. So that is an earning per share. And the last one is market value method or market price method. So this will calculate according to the what is the actual price currently in the market, so of the one individual share. So on the basis of the market price of that shares, so we are going to ascertain that swap ratio or share exchange ratio. So that will called as an market value method or a market price approach. It's clear? Okay, let's start with the first problem. Okay, here is the first problem. So in this problem, Ram Limited wants to take over Rahim Limited. The following details of both companies are as follows. So what is mean? Ram company is going to acquiring the Rahim company. Ram company is going to take over the Rahim company, and then they're given the three items belongs to a problem. One is in profit after tax. That means how much of profit they earned after deducting of the all the tax and depreciation and interest and all. So how much of money left over in the business, that money are called as a net profit or profit after tax. And the second one is preference share capital, and the third one is equity share capital. So the two items belongs to an capital item. And the last one, you are required to calculate the share exchange ratio or swap ratio to the shareholders of Rahim Limited based on earning per share method. Okay, let's start the problem. Okay, it's clear. So the problem is clear. Ram company is going to acquiring the Rahim company. So we need to ascertain how much of shares actually offering by the Ram to Rahim shareholders. Okay, so in order to calculate this problem, so we have the one formula. So that is a swap ratio under the EPS approach is equal to earning per share of acquired company divided by earning per share of acquiring company. So if we deduct that earning per share of acquired company by the earning per share of acquiring company, so we will get a swap ratio. Afterwards we will calculate how much of shares actually offering by the Ram to Rahim. Okay, first try to understand what is the meaning of the earning per share. What is the meaning of the earning per share first of all? So that means one individual share, how much earning. So in order to calculate the earning per share, just go to that accounts class. How can we calculate the earning per share? So that overall profit divided by number of the equity shares. So afterwards we will get earning per share. How can we calculate? Earning per share is equal to profit after tax divided by number of shares. Okay, now calculate the earning per share. First profit after tax. Take a look into that problem. So they already given profit after tax is Ram 4,80,000 and Rahim 3 lakh rupees. So just take first. We got the profit after tax. So that is how much? So Ram is 4,80,000 and the Rahim is 3 lakh. 4,80,000 and then 3 lakh. So now we got the profit after tax. Now we need to ascertain the number of shares. How can we calculate the number of shares? Okay, number of shares is equal to the total worth of shares divided by price of the share. So total worth of the share divided by the price of the one individual share, we will get the number of shares. Okay, what is the meaning of the price of the share? What is the actual price currently that one individual share have in the market? So there is a price of the share. Okay, there is a difference between price of the share and earning per share. Okay, so what is the exact difference? Which is to take a example, price of the share. Okay, price of the share. So that means how much money we need to give in order to purchase the one share. For purchase the one share, so that is an price of the share. But earning per share, so with the help of the one share, how much we are earning. So that is an earning per share. Price of the share is how much money we need to give for purchase the one share. But earning per share is how much money we are earning with the help of the one individual share. So okay. So here we got that. So total worth of shares. First we need to calculate the total worth of the shares. In this problem they already given. So total worth of the share of the Ram is 10 lakh and then Rahim is 5 lakh. So Ram holding the 10 lakh worth rupees of shares and then Rahim holding 5 lakh worth rupees of shares. And again come to that particular spot. So there will be in 15 rupees. That means one individual share have the value of 15 rupees. Here overall value is 10 lakh. So 10 lakh divided by one individual share price, we will get an number of shares. Okay. So let's start with the Ram. Ram, how much total worth of the share? It's 10 lakh. It's 10 lakh. And then divided by one individual share is 15 rupees. And again next Rahim, so worth rupees 5 lakh. 5 lakh divided by individual share value is 15. Is 15. 10 lakh divided by 15. So we will get 20,000. And then Rahim 5 lakh divided by 15. So we will get 10,000. So here we got the number of shares. So that is in Ram is 20,000 and again Rahim is 10,000. Clear? So now let's move to the next step. So in this problem we need to get the earning per share. For that we need profit after tax. Yes, we have. And then next number of shares. Yes, we got. So next calculate the earning per share. First Ram and then next Rahim. For Ram, profit after tax is 4,80,000 divided by number of shares is 20,000. And then next Rahim is in 3 lakh divided by the number of shares is 10,000. 4,80,000 divided by 20,000 is 4,80,000 divided by 20,000, it's 24 rupees. Next 3 lakh divided by 10,000, 3 lakh divided by 10,000 we got 30 rupees. 4,80,000 divided by 20,000 it's 24 rupees and then 3 lakh divided by 10,000 it's 30 rupees. So here we got the earning per share of Ram, earning per share of Rahim, 30 rupees. So now just apply to the formula. Earning per share of acquired company. Who is acquired in this company? It's Rahim. So then acquiring company is Ram because Ram is going to acquiring the Rahim. So that's why Rahim become an acquired company and the Ram become acquiring company. Okay, EPS of acquired company is Rahim, it's 30 divided by, and then acquiring company is Ram, it's 24. 30 divided by 24, here we got the amounts, 1.25. It's clear. So 1.25 is actually a swap ratio or earning per share approach. So it's clear. Next, move to the further. So what is the next step? So we got the swap ratio. Swap ratio we got 1.25. So what is the use of this swap ratio? So with the help of this swap ratio, how much we need to earn from the perspective of the Ram? How much Ram is actually going to give offering the shares for the Rahim? So because of Ram holding the 4,80,000, sorry. So Ram holding the 20,000 share and Rahim holding the 10,000 share. So those two companies have going to acquiring. So that means Ram is going to acquire the Rahim company. Ram is 20,000, Rahim is 10,000. Now those two companies become one company. So while becoming a one company, Ram is offering the how much of shares they are offering for Rahim. We need to calculate. That's why we got swap ratio. Now we are going to calculate how much exact shares. So next, shares offered by Ram company is equal to number of shares of acquired company into swap ratio. So number of shares of acquired company is 10,000. Okay. So 10,000 into swap ratio is 1.25. 10,000 into 1.25, that is an 12,500 shares. So what it is means? So now Rahim company holding the 10,000 number of shares, but after the acquiring of this company, so Ram company's shareholders will hold the 12,500 company. So 12,500 shares, because Ram is acquiring the Rahim. After the acquiring, Rahim is selling everything to an Ram, and then he exit their presence from the corporate world or business world. He sell everything. So what is actually belongs to a Rahim? So assets, shares, everything he will sell to Ram, and he will exit from the business. While he exit from the business, so shareholders are their partner of the business. So now they are holding the 10,000. So while acquiring this company, Ram is going to offering 12,500 for Rahim company. Okay, it's clear. So it's a simple problem. So there is no confusion, I think. So if you have any doubts, kindly rewatch or kindly ask me. Okay, thank you.